Well, good morning to all the people that are listening to this. It's an interesting quarterly review this time because a lot of things have changed over the last quarter, over the last 3 months in terms of both macroeconomic data, things that have actually transpired in property markets around the country, government incentives in terms of the 5% deposit guarantee, and a lot of other things that really are going to have a fairly profound impact, I suppose, on what happens to housing prices in the various markets around Australia. So I'm pretty sure that everyone will be able to find something of interest, whether you're just a spectator in the markets or whether you're looking to build your own portfolio or have other specific reasons in mind. So without any further ado, let's go on and see what the data has to tell us. First of all, a bit of a disclaimer: this is general information and not designed to be specific advice or financial advice. And if anyone requires that, then clearly that's something that they need to speak to their advisor about, or contact us and we can assist them in their own particular situation. But for people who don't know us, just a little bit of an overview in relation to what we do. Wise Guru is the international consulting business that was established to assist Australian expats in the main and other people who live around the world, to assist them with all the facets revolving around acquisition of property in Australia. So as we all know, it's quite difficult sometimes to make these transactions come to pass and be efficient and well informed in that process. So Wise Guru helps people to make informed choices, I suppose, to assist them with information, with data, and also look at their own situation and see how we can assist them in a particular manner that may suit them best. The other facets of the businesses that we have around the globe: Unicorp Partners is the financial advisory business based in Sydney, Australia. Aussie Loan Guru, as the name suggests, is our lending business, which gives special situations to many of our clients, especially those ones who are Australian expats living non-domestically, so around the world, where we can often give them up to 85% loan-to-value ratios without them having to pay LMI or lender's mortgage insurance, which most people who have been in the market or have taken loans will recognise is a very costly expense at times that doesn't give them any benefit. It goes to the lender. And then in Australia, Aussie Property Guru is the registered and licensed Australian real estate business. So that's just a little bit of background, and we'll show you how it all ties together. But in general terms, our clients have certain demographics that run across various vocations. Doesn't matter if you're a neurosurgeon in Sydney or a banker in London or Singapore or Hong Kong. Most of our clients are really time poor, and we all know what it's like to be time poor. It's frustrating at times, and most of our clients want to buy property in Australia, but they want to make well-informed choices, and they want to build their wealth in an affordable and in a tax-efficient manner. It's difficult because they're so time poor, they're earning high incomes and they want to do something with that, but quite often which way to do that correctly is not easy to see. So we've developed over time our concierge service, where we basically assist our Wise Guru clients, if they so choose, with our concierge service that facilitates the acquisition of Australian residential property, and it's designed to assist them on an investment basis, so that if you're looking for a home to live in, it's probably different, because a lot of the choices you might make are based around qualitative parameters, where you might want to live in a certain place, have a certain home to live in. But if you're looking for an investment property, then the attributes you are looking for or should be looking for are probably somewhat different in terms of both capital appreciation, rental yields, ease of maintenance, ease of rentability, and many other financial or commercial factors that need to be considered. So we help people with a list of a whole host of professionals that we deal with in various states that assist our clients with both legal, accounting, tax, and management functions that are necessary when you're buying investment properties. Okay, clients that know us will know this. We try and cover off and look at what are the most common questions that we get asked, and it sort of changes. I mean, themes tend to go for longer than a quarter, but things can change, and certainly in this last quarter, the questions around what's the Reserve Bank of Australia going to do with official interest rates, official cash rate. And that's changed a lot, because 3 months ago, virtually all economists were looking at a number of rate cuts to come, both still this year and then next year in 2026. We've had a couple of unexpected numbers come up, both mainly in the CPI, last quarterly CPI, and that sort of sidelined the RBA, and now economists and so top 4 banks, the big 4 banks, economists are looking at different scenarios in relation to what's going to happen to rates. Are they going to remain on hold? Will we get further reduction? No one's really speaking about an increase yet, but we're getting that question from our client base. And the other questions that are really, really common at the moment relate to the increase in housing prices. And if you look at that, quite often you would think, well, if rates aren't coming down further, that may put a bit of a hold on price increases. But as you'll see as we go through some of the data, I don't think that's going to be the case, and I think prices will continue to rise, and in some areas I think fairly strongly. So which are those areas, or which areas are going to be impacted by some of the macro factors that really drive both rental growth and price appreciation? Where are they located geographically? Clients are also asking, especially if they're already owners of investment properties, will this current increase or uptick in rents continue further? And we'll go through that, because that again's changed this quarter. And we're getting still some questions about, will the government change negative gearing? I expect that'll, like most years, increase when you get to close to budget time, because it's happened every year that I can remember for the last probably 25. So I can't stress this enough. Australia is such a large country, it's a continent, and it makes research essential, because there are so many property markets within this country, and they're all somewhat different depending on the underlying economics and also property migration patterns that are occurring in those various regions. We'll go through that. We obviously rely on a lot of national data, and I mean the ABS is pretty good. They bring data to the fore on a constant, regular basis, but you've got other national data providers, Cotality, Resolution, Oxford, and so on, and it's really then a question of trying to put all that together, because if you just want to look at data, I mean, there is just so much data that one can look at. It's difficult to then sometimes make a choice, because a lot of it can be conflicting. So, this is the big one. What's going to happen to interest rates? And last quarter, certainly most people, most economists thought that November Cup Day, the RBA meeting on Melbourne Cup Day, would bring a rate reduction. That didn't happen, and I'll go through the reasoning behind that, but it was a surprise, and this is what I'm saying. Quite often these matters end up coming as a surprise, and in retrospect you think, well, why are these decisions made on such a small change in economic patterns or economic data? But the uptick in the September quarter CPI really put the cat amongst the pigeons there, and the RBA decided to leave the cash rate at 3.6%. So, and then after that we saw a change in employment numbers, and I'll show you that. Unemployment dropped a little. So currently the big four bank economists go from CBA, who is expecting no more cuts in this rate cycle, to Lucy Ellis at Westpac, who's expecting 2 more, and the others 1 more next year. Again, I think it's really important to bear in mind that these projections or forecasts have changed and do change a great deal depending on a mild change sometimes in underlying CPI conditions. So it won't be surprising to me, certainly, if you get a change in this. But I think at this point in time, being most realistic, I suppose, about this, for now, I don't see a change in the RBA's official cash rate setting until probably May, next year, so mid-2026, where I do anticipate we get another 25 basis point reduction. We'll just have to keep an eye on that, as of course we do, and keep our clientele around the world aware of what's going on. So if you have a look at what happened, this unexpected uptick in inflation, if you look on the left hand side here, annual change of inflation, last quarter we had you look at the pink line, it was really coming down in a fairly steep manner, and then we've had this rebound here, and that's what's caused a reaction by the RBA. And if you look at this graph here, as you can see, that decline in rates is shallower than it was last quarter. Also, unemployment came in for October at 4.3%, and that was a decrease of 20 basis points, down from 4.5% in September. So that adds to a feeling that the economy is stronger than previously thought. Certainly those numbers play that out. But on the right hand side, because people talk to us about how these situations are going to impact property prices. And as we can see here, the change in house prices, if you have a look at the bars in the graph, in the 2 years after the start of a rate cut cycle, you look at the percentage change in those situations, it was pretty robust. And don't forget, this year we've had the RBA cut the official cash rate 3 times by 25 basis points, so 0.75% decline. And the only time here when you had fairly muted increase in prices was when you had unemployment at or above 10%. So currently, that's what I'm saying, that's one of the other situations, unemployment's at 4.3%. So it's very, very low. It's at multi-year lows, and looks set to continue. I think some of that needs to be held in context, with government being the largest employer in the country in its various guises. So the Australian economy is somewhat different to others, but we'll see what happens at the next set of data. Pardon me. If we look at interest rates for all of us, borrowers in the retail market, they've remained fairly steady over this quarter. A few of the banks have increased their longer term fixed rates by a small margin, but realistically there hasn't been much change and everything's been fairly steady. So here are the Westpac forecasts out to the end of 2027. They've changed quite a lot from, as I say, the last quarter, but Lucy Ellis expects there'll be a rate cut mid next year, 25 basis points. I tend to agree with that. And then Westpac also expects there to be a further rate cut in Q3 next year, which is a bit different to the other bank economists, and we'll see how that plays out. But I think there are 2 other things that we need to bear in mind here, and one of them is, which is very important for Australian expat clients, what happens to the exchange rate? What happens to the Aussie dollar? Now, currently, there's been some, a little bit of a strengthening in the A dollar, obviously, over the course of this year. And if the RBA remains more hawkish than its counterparts, especially the Fed, if you're looking at the pair against the US dollar, the Aussie dollar should continue to appreciate, which I think is something that will happen, because I think the Fed is far more likely to be and continue to be on a more dovish interest rate stance. It looks like they'll cut next month in December and continue to do so during the course of 2026. There's been quite a bit of chatter about the value of investor lending, and the APRA, the prudential watchdog, speaking to the major banks in relation to the increase in investor lending and so forth. But I think it's really important. This is where I think experience comes in and becomes very valuable when you look at these numbers, because if you look here at this graph on the left hand side of the screen, and you look at the top line, that's New South Wales, 43.2% is investor lending as a portion of all lending. Now, if we look at the market in New South Wales, the various markets, Sydney being clearly the largest, I don't think investors are piling in there because it's providing them with a massive amount of upside from an entry price point viewpoint. It's more, I believe, that more and more, especially younger Australians, are looking at this a situation where they want to live somewhere, particularly in Sydney, metropolitan Sydney, and they can't afford to buy the house they want to live in. So what they're doing is buying an investment property instead and renting where they're living, or the rent vesting situation, because they still want to be in the market. They can afford to buy something that's getting them an income. They can use tax advantages to help them acquire that property, and it makes sense. Whereas, say in some of the other markets, the percentage of investment lending is far more, I suppose, indicative of it being truly lending to investors, where they're looking to position their portfolios to make advantage of further upside they think they'll gain over the next number of years. So important to bear that in mind. The other macro that's clearly very important is population growth. So, population growth in Australia, it's generally in various markets. Obviously, births over deaths, so natural increase in population, and then it's net overseas migration. But with Australia being such a large country, interstate migration becomes very important also. So if we look at this, and we look at all the latest ABS numbers every quarter when they come out, as we can see, and this has been going on for some time now, we've come down from the post-COVID peak, but still, those numbers and those levels of population growth continue to be really high, especially when you compare them to other developed nations. And it still looks like it's going to continue. So the peak's been reached, but everyone, certainly in the Australian marketplace, will know that population growth continues to be, to people who are wanting to enter the market, a bit of a challenge. These forecasts were done a little while ago, but continue to track pretty well to what the government, the Centre for Population Projections, came up with, and we'll go through some of the data during the course of this to show you where that's happening. But in general terms, WA, Queensland, and Victoria are the three states that are sort of leading the way in terms of percentage-based population growth. We'll look at some of the nominal figures as well, because they're important. So when I come back to the situation of APRA potentially looking at the banks and the number of investment loans that are being made by the various lending institutions, housing credit in general, the regulator needs to keep an eye on the robustness of the lending criteria of the banks, and it's really been very strong. We know that through our lending business, and anyone who goes to get a loan will also tell you that the process is very rigorous, very robust, and there seems to be very little chance of an upset being felt in the marketplace due to lending practices that the banks utilise. If you have a look here, the percentage of loans being originated with an LVR, loan-to-value ratio, of greater than 90% continues to track at a very low level. Percentage of loans originated with a debt-to-income ratio above 6 times, again, tracking at a low level. Loan-to-income ratios at 6 or above, steady at a low level. The percentage of loans interest only has increased, and the reason for that I think is pretty simple and pretty straightforward. As we've had over the last number of years, this increase in the official cash rates, thereby passed on by the banks in their lending rates, people have at many times, to manage their cash flows, converted from principal and interest to interest only, so that their monthly loan repayment commitments came down. Overall, I think it's a really robust situation that we're seeing in the banking marketplace. So now if we look at property as an asset class, I think it's really interesting, especially what's happened in the last quarter. So let's have a look at that. The value of residential real estate in Australia has ticked through $12 trillion. If you look at that, it's actually a very significant sum. And whilst people, especially some of our overseas clients, speak to me and say, oh look, the price of property in Sydney or in Australia is just crazy. I don't know how people afford it. Where do they get the money from? Well, if you look at that slide, a bit of context, you can see that the outstanding debt against that $12 trillion is only 2.5. So, you're talking about a 20% leverage situation. But human nature being what it is, everyone thinks everyone else is in exactly the same position as they are themselves. So if you're trying to buy something and you need a larger mortgage, you think that everyone else that owns a property has a large mortgage. As you can see there are a massive amount of people that don't have any mortgage, and there's another massive amount of people who have a very low one. So I think that also should give people a lot of comfort, but more importantly, I think people need to consider about what type of properties, what style of asset, and in what locations they should look towards in terms of investment, because some of these demographics will have different capacity to others, and I'll go through that in more detail. So if we look at the National Home Value Index, this has come from Totality, last 12 months, I think this is a good number, I suppose, 6.1% increase in housing values. There's nothing too strong about that, nor too weak, but you've got to look at the other numbers. I mean, you think the last quarter has represented nearly half of that. Clearly, there's been an uptick during the course of this year, 2025, in the rate of value appreciation. And then on the right-hand side, if you look at, what's the premium between houses and apartments, and it's nearly 50%. So especially in high value markets like Sydney and Melbourne, that's had a big change, and we talk to our clients and you speak to people in the marketplace, and that again will have ramifications, and I'll go through that, because a cohort of people, a very large one, that are selling their homes they might have bought 30 or 40 more years ago, are generally then looking to enter the market and potentially in a different asset class, as in a different asset type within residential property, and they're going to pay cash for that. So let's have a look at the quarterly changes. As you can see there, the last 3 months, I mean, the changes are positive, except for regional Northern Territory. However, there's a pretty wide dispersion there. Sydney's up 2.3%, but if you have a look at some of these, for example, Darwin 5.4, Perth 5.4, Brisbane 4.9, obviously very different amounts. Melbourne, 1.6. So, and that's why I'm saying research is so important over this, over this large continent, because it's not generic. You can't just say, oh, Australian property has done this or this or this, because it depends where. Then we look at this in more granularity. If you look at the various value segments within some of these markets, you can see that uniformity of increase has been pretty significant, and I would suggest that some of the increases that we've seen in the bottom quartile, so the orange bars, has really picked up steam. We've seen that just from client and consumer demand, with the government's 5% rental guarantee being brought in over a month and a half ago, and that's really, I think, turbocharged a lot of first home buyers who are able to utilise this, because the income caps have been removed. So if you're living in Sydney or Brisbane or Melbourne, the price caps have been increased, the income caps have been removed, and a lot of younger people are trying to utilise this to enter the market, and that has increased demand, and we've also seen has increased prices, especially in that segment. But you can see that most capital cities, certainly the smaller ones, Brisbane, Adelaide, Perth, that price growth has been very strong in all segments. And a lot of that comes back to this sort of age-old conundrum that we have in Australia of supply and demand. The Australian residential property market is substantially undersupplied, especially in areas where people actually want to live and want to acquire a property. So it's one of those situations where the government is trying to create a situation where they're going to build sufficient homes in their mind to try and alleviate this problem. But I think even the government now realises that's really a bit of a sort of pipe dream and there to lure potential voters. The reality is that undersupply continues. It's a situation that in most areas where people really want to live, it's something that's not going to be able to be fixed, I don't believe, for a very long time. And it could be a matter of decades even in some places. So I think it's something to bear in mind, and think about this if you're a property investor, because supply and demand is always truly important. So if there's a large level of demand and a small level of supply, you're always going to be in a very good position if you're an owner of an asset in that particular situation. This is a question that we get even more so now, and I think during the course of 2025, and I'm thinking that will probably happen over the course of the next year as well, where people are saying, they recognise that both property and equities are growth assets, but they're saying, what's better, equities or housing? And as I've always told people, it really isn't a question of which is better. I think it's important that you're able to continue to grow both silos, if you like, both of these asset classes, because most importantly, they provide, I think, a different ride along the way. So we all know how we can value equities. We can get it on our smartphone, we can get it on a laptop. It's mark to market, so the value is changing on the values of all these shares whilst we're having this review. Whereas with property, it's a far more stable situation. And the other really important issue with this is that quite often when you borrow to invest, and certainly with property, most people who are investing would borrow because it makes good sense to use somebody else's money on a tax efficient basis. Pardon me. However, if we apply the same principle to equities, and it applies, the outcome can be very different. So the value of shares could decline or increase, say 20% tomorrow, and if you've borrowed against that asset, then the lender will say, look, you've got to put in X amount of money tomorrow at 10 a.m. to meet that margin, requirement, to maintain, let's say, an 80% loan to value ratio or 70%, whatever you have. But if that happens to property, the bank doesn't actually do that. As long as you're able to meet your repayments on a timely manner, they won't contact you at all. So using leverage in property is a far different, and to me far more conservative and safe, if you like, mechanism to grow wealth than to do it in equities. And we obviously use different mechanisms for various asset classes, but that comes down to sort of more personal information that we need to do. But if you have a look at the returns from housing and the returns from equities in Australia over the last decade have been very robust, and certainly if you look at that on the housing front with the undersupply that currently exists, I think that will continue. A lot of our clients who currently own properties are saying, what's happening in the rental market? And then conversely, you have younger people especially who are renting saying, asking the same questions, probably for different reasons. Pardon me, because a landlord is looking for a higher rent, has a higher return on their investment, whereas somebody living there is looking for a lower rent to reduce the expense of having a roof over their head. If you have interest rates that remain higher, currently, I think that our monetary policy settings are still restrictive, then you're going to have rents that are higher. And I'll show you in a moment, but there's some interesting data that's come up in the last quarter. So if you have a look at this uptick here, at the right-hand side of the graph, the rate of rental increase was coming down quite nicely and gradually, but now it's really, over the last quarter, shot up quite strongly. So that's where we're getting questions from our clients, especially ones that are having lease terms coming up and being renegotiated. And you can see from the bars there on the left-hand side how that's varied. Look at Darwin, annual change in rental rates, nearly 8.5%, 9.5%, Sydney 4%. Melbourne is the only sort of larger capital that shows affordability. It's only been a 1.8% increase in rents over the last 12 months. But you can see again this dispersion of results where it's really important to have a look at where your property is. And some of these things you talk through people who are saying, I can't afford to buy an investment property in Sydney, so I might buy one in Melbourne. Well, you have to look at some of the other parameters around that. What's your income going to look like there? And clearly, with Melbourne in particular, you've got to look at the taxing points because Victoria is quite different to the other states in relation to taxing property investors. But overall, national rental value is up 4.6%. So, it's expensive, I suppose, if you're a tenant, and I think it's pretty strong if you're a landlord, given the fact that you've had pretty substantial capital growth on those assets as well. In terms of rental yields, they haven't really moved that much, as we can see, 3.6%. I think that the peak not that long ago, years, was 3.77%. But if you look at that, that's very steady as she goes, if you like. As you can see, Darwin again had a very large increase compared to other cities, but across the board, it's pretty strong. And I think the yields will potentially decline over the next few quarters. And the reason for that is that I think capital value appreciation will probably outpace rental growth, if that makes sense, because it's an inverse situation. So yields may drop even though rents will go up. So what does all the data tell us, and how do we use the research? How do we then, formulate our own ideas in terms of what might happen over the next 12, 24 months, 5, 10, 15 years? Because I think when you're looking at property, you have to have a longer time horizon. And as most of our clients around the world will know, because they say, what's happening in the Aussie property market? And you go, well, there is no such thing. As I think I've already pointed out, there are so many different markets around the country. They're all acting differently. So, what else do we look at? Because you can't just say what's happening in the Aussie property market. As we know, if you're living in, say, Singapore or Hong Kong, you could easily do that because both of those locations are geographically very small, and what happens on one side of the island to the other is not going to be that different. So, let's look at new listing activity. And again, it's really diverse. Up until 26th of October there, relative to last year. But I think one thing that we can see from the data there, even just at a perfunctory glance, is it's lower. New listing activity across most of the capital city markets and regional markets, whilst it was diverse, it was lower, especially in the sort of mid-sized capitals. So you've got far less ability to buy something. There's far less stock on the market. So that again exacerbates the situation where, even if you had more supply, it's not on the market, so it's not usable supply, and people can't buy it. So that will continue, I think, to keep underpinning prices also. This is something that came through after COVID, and it's just structural trends in terms of what people are looking for. We're finding this, and we've found this over the last 5 years, where people, when they're looking to buy new living space, or if they're looking to rent a new living space, they're looking for, generally speaking, a larger style of dwelling, particularly when you're looking at apartments. And the advent of the MPR, or multi-purpose room, has been something that was really strong, and I think it's here to stay. So people are saying, well, look, if I'm living in an apartment, I'd like to have this flexible space, this multi-purpose room. So if I want to do some work from home, I can turn it into a home office. But if I have, guests or relatives coming to stay, I could potentially use it to house them there for a short period. And we see that as being a pretty important thing going forward. It's certainly something that most of our clients are now recognising the value of, both in a situation where they're buying something as an investment to rent out, because they know people will find that valuable who are going to be tenants, and also if you're an owner-occupier, you see the value of that when you live in it yourself. So that leads into some things, and this is one of them. People said to me, look, the last 5 years in many of these property markets, the growth has been unprecedented. So just to stop there, it hasn't been unprecedented. In fact, there have been periods of 5-year growth which have been far stronger than we've seen in the last 5 years. But the last 5 years has been a very robust period of growth, and I think it's something that's going to be that will continue in certain areas, but perhaps not in others. So again, this situation where you need to have research, or you need to have someone assist you with research so you can make a better informed choice is really important. And we're now seeing, and I think, economists are sort of somewhat a little bit divided in terms of what's going to happen over the next year or two in relation to housing value increases between, say, Sydney, Melbourne, and then some of the smaller capitals, where some are saying, well, look, we're going to get this bigger uptick in property value growth in Sydney and Melbourne as opposed to the other capitals, and others are saying the opposite. And I'm probably leaning in that camp, where I think property values are going to increase more in the likes of Perth, Brisbane, Darwin and Adelaide than they are in Sydney and Melbourne. But you've got to look at that on a percentage basis too. And in Sydney in particular, I mean, you're already starting from a very high bottom line base. So it's still Australia's premier housing market. It's the most expensive by far, and it's something that people need to keep an eye on. But as we update this over the coming year or two, people will see what's actually happening on the ground. And I think some of the areas that we continue to look at will have a far stronger period of growth than others, and we'll go through that in a bit more detail. So, short and long-term value growth there, if you look at the last 5 years, and I think here it's a pretty good situation, Perth 82%, Adelaide 77%, Brisbane 80%, Sydney 38%, say Melbourne 17.5%. So, massive amount of divergence, and it's something where you can see on the left-hand side there, if you look at the shape of those graphs, you can see that really the smaller capitals, the mid-sized capitals, are trending up far more strongly than the others. And I think that's probably set to continue, but for structural and underlying reasons more so than just the fact that they're smaller markets, or they may be starting from a cheaper price point. So when we tie it all together for people and say, how do we do all this? And we say, look, it's as easy as pie, but that refers to population growth, infrastructure growth, and employment growth. And they're key metrics that if you have those and you buy a quality asset in a location that has those tailwinds, you're going to do far better than the average. And that's always a difference then on a pie chart or in a distribution curve. It's nice to be on the right hand side, and you can generally do that through getting some assistance. We look at the various markets around the country, and let's look at New South Wales or Sydney. New South Wales is the most diversified economy in Australia, but the biggest problem in Sydney is affordability, and that's been declining as we've been going through, because prices are still growing, interest rates have now plateaued for the time being. So that really is a challenge, and ongoing demand for quality, we see that, and we see that particularly from people who are downsizers or right sizers, who've sold something and want to move into something else, but also for younger professionals that are looking to scale up, I guess, in the marketplace. They're looking for quality, and then you've now had the additional influx of first home buyers, a surge of first home buyers that it's challenged in a city like Sydney, because they're generally going to have to look at a location that's a long way from the CBD, or the second part is that they're going to be buying apartments if they want to be closer to amenities, as most people do. So, but if we have a look at the quarterly growth of house prices in Sydney, we'll see that in a second, it's important, and immigration demand remains, net overseas migration is the strongest of anywhere in Australia. So if you look at that, Sydney's gone up 4% over the last year, but more than half of that's occurred in the last quarter. So I think that's where, if you look at the trajectory of this, that's really important. And that's happened during the last quarter. We've had no reduction really in rates to drive that further. So that's really important, I think worth bearing in mind, because I can see that continuing. As we just saw in terms of supply and demand, that's what's happening. If we look at Melbourne and Victoria, it's really a very different situation. I mean, overseas immigration, their net overseas immigration is second strongest, generally speaking, to Sydney. and Melbourne does very well with its tertiary learning institutions, so they get a lot of overseas students going there as well. And rental affordability remains strong. It's got the second lowest growth of any of the capital city markets in rental values. But again, quarterly prices have ticked up, and look, I think the return of overseas students may be at risk due to some government caps, but that yet has to play out. But if you have a look at it there, Melbourne rose 3.3% over the last year, and again, half of that's occurred in the last quarter. So whilst being more subdued than Sydney, the trajectory is the same. So it's something, if you have a look at that, to keep in mind. Again, I think that'll continue. But then if you have a look at Perth, for again a very different, if you like, flavour to what's happening, annual capital city price growth has now slipped behind Brisbane and Darwin, but it still has high population growth, high annual rental growth, and I think the issue that's creeping in there is affordability. So, slowing affordability. But otherwise, economically, Western Australia is still doing very well in terms of commodities, and I see that as being another strong growth market for the next 12 months at least. So if you have a look at Perth, you can see they're up 9.4% over the last year, and again more than half in the last quarter. So we can see there that uptick's smaller, but it's nonetheless still there, and I think worth bearing in mind. Bit of a caveat there again, I think just affordability is starting to become a little bit of a challenge in Perth. This is brought out by Cotality, their HVI, their Hedonic Home Value Index, and the latest numbers, if you have a look at that, the median value, as you can see in Sydney on the right hand side there, way ahead of anywhere else. But Melbourne has now slipped behind the likes of Brisbane, Adelaide, Perth, and Canberra. So quite interesting. If you've spoken to someone 4 or 5 years ago and said that's going to happen in Melbourne, I don't think anyone would have agreed with you. So really important to keep an eye on this, and we do on a monthly basis. And then we get that question that's asked by, I'm talking about investors here generally speaking, should I buy something new or should I buy something old? And there's no right or wrong answer to this. It depends very much, I think, on the person and their circumstances. So, if, let's say, you've had experience in the construction industry, you've worked in the building industry, and you're going to retire, you might look to buy an older dwelling where you can add value through renovation or redevelopment. The redevelopment side's probably pretty difficult these days because trades are very difficult to obtain, and they're also very expensive. So you really have to know what you're doing and be pretty confident that you have the resources available to make that happen if you're going to embark on that route, I think. But the flip side of that is if you're buying new property, generally speaking, obviously you've got builder's guarantee, so fewer or shouldn't have really any maintenance or repair issues to consider. It's easier to get better tenants, it's easier to rent, and certainly easier to manage. So it's a situation where it's horses for courses. And then the other thing, of course, that comes in Australia is that we've got an interesting situation where under our income tax law, we can utilise the, say, Division 43 and Division 40 depreciation allowances. Now this really generally relates to new dwellings. So, you can write off the cost of building that new dwelling at 2.5% per year for 40 years and offset against your other personal exertion or other income. And you also, if you get a quantity surveyor's report done, have the opportunity to deduct fixtures and fittings under their various half-lives, which may vary from 1 to 15 years generally, that you can offset against your other personal exertion income. So you get a real benefit, I suppose, from doing that. Obviously with old dwellings, they've already been written off, so you're not going to get that. So what does all that tell us? Because, as you can see, we look at an awful lot of data, and this is only part of it, but, what do we do with it? What are we going to achieve by looking at that data? And we've been saying this for a number of years now, that Southeast Queensland has been the area that we felt was the best in terms of potential investor returns, and that's played out. So it's still the case. There's still a substantial value gap to Sydney, It's showing, southeast Queensland, so that's mainly if you look at Brisbane, the Gold Coast, Sunshine Coast, strong rental growth, and I think some really strong structural growth winds. I'll get into that. One of them is, it's continuing quarter by quarter to see the strongest interstate migration we've seen for 15 to 20 years. It's one of those locations where the whole work from home scenario that, evolved from COVID, but has now become a bit of a mainstay in the Australian landscape. Population has adjusted to that, and many people find that a great outcome to have that balance of being able to work from home or from the office. It's, I suppose, strongest that we see stronger certainly in those locations, because a lot of those are lifestyle locations, especially if you're looking at the coastal markets, and that's enhancing growth further. And Queensland does have a very well diversified economy. It's not just a mining state or commodity state, as people say WA and Queensland, but the economies are not the same. So you've got to look at all of those situations, and then if you look at the numbers, you can see here, home values have gone up 10.8% over the last 12 months. Again, almost half in the last quarter. So, pretty strong, and I think that's set to continue, and I'll come through some of the other tailwinds in a moment. But if you have a look at this, and this is where it's really important, have a look at the numbers, and if you look at net interstate migration, New South Wales is losing the most number of people, over 26,500 over that period, compared to anywhere else. And Queensland is gaining the largest number of people, over 24,000 over that period. So, these are pretty important numbers. If you look at net overseas migration, as I said, New South Wales, and that's usually Sydney, always generally the highest, 97,000, 93,000, again mainly Melbourne rather than Victoria, 54,000 in Queensland, and so on. But the people that are coming from overseas, we find generally want to rent something for a few years before they buy or are able to buy, whereas the people that are moving from interstate, they're generally already Australian citizens, if not permanent residents, and the reasoning there is different. They're looking to put their kids into different schools that may be cheaper, they've got employment in different areas, so they're probably looking to buy something in the very short, if not immediate future. So different demographics entirely. If you look at that on a graphical basis, you can see, New South Wales, really strong net overseas migration, really large outflow of population, and Queensland is the beneficiary of that. So, pardon me, if you have a look here, the ABS numbers will continue to show, I believe, what's been happening over the last few quarters. That trend is set to continue. And if you look at what's being projected in terms of population growth for Brisbane and for southeast Queensland, I think that's a massive tailwind. I think with the low level of supply, with this high and increasing level of demand, it makes that southeast Queensland corridor or triangle, to me, one of the best areas to look at from an investment viewpoint. So if you look at this, and these are just some numbers in relation to what's required in terms of a market or a balanced market, and the Brisbane market requires about 7,500 new dwellings, new apartments to keep that balanced marketplace. This is within 5 k's of the CBD, and as we can see, supply hasn't reached that for since 2016, basically 2017. So it's a long way down the track, and there's not really any inroads being made currently in relation to new supply coming to market, and a lot of that is due to the cost of new supply, the cost of building something, the lack of builders to actually build those dwellings, and the difficulty in obtaining trades to do so, and also the productivity of trades involved in the building industry. So developers are finding it very difficult to create new supply. Whatever's there is in high demand, and that will continue to put a floor under prices, but continually, as we've seen, have that floor increase. And just looking at at the situation, I can't see that changing, in the foreseeable future, unfortunately. One of the other tailwinds, and it's not, the 2 to 4 weeks that the Olympics and Paralympics are actually going to be in place, but it's more about the infrastructure that's being built and developed in this lead up. And 2032 will come along, pretty quickly. 6 years next year, 2026. So people will say, "Oh gosh, the Olympics are around the corner." And I remember what happened in Sydney when Sydney hosted the Olympics in 2000. If you look there, housing values in Sydney rose at almost twice the rate of the broader market or the combined capital city benchmark. And I think we'll see that happen in southeast Queensland as well. I think the other really important tailwind there is also, if you spoke to most people overseas before 2000, they knew where Sydney was. But if you speak to people overseas, a lot of people don't even know where Brisbane is. So once you have billions of people seeing where it is and the place, etc., I think it will also open up another dynamic where the region will become even more appealing and of interest, I think, to the global market. So that's something to keep an eye on. These are just major tailwinds that I think exist and are not going away. In terms of infrastructure that has already been developed, is nearing completion or has just begun, all you have to do is actually go to Brisbane and have a look from a personal viewpoint, and you can see what's happening. I think that's underlines exactly what's going on. There's a massive amount of employment being created there, massive amount of efficiency, new amenities, new infrastructure. So it has the hallmarks and the underlying components necessary to maintain that, I think, upward trajectory in value growth.
This Games was never going to be like other games. It'll be a Queensland Games. We can't just build for a few weeks of competition. We've got to build for the decades to come. We need a plan, and it's time to deliver.
The only thing bigger than the Olympic and Paralympic Games is the opportunity to connect Queensland by building the roads and infrastructure we're going to need for decades to come, all while we drive tourism and back our grassroots clubs. And now the new Queensland Government has set the plan to deliver it. To keep our growing population moving now and beyond 2032, Queensland needs a better connected and accessible transport network. For Brisbane, there'll be new rail lines and stations, with new northern and eastern bus priority corridors, and road upgrades will get people around a growing city. There'll also be an exciting new sports and entertainment precinct in the heart of Brisbane, where Victoria Park will become home to Brisbane Stadium, designed to attract world-class events. The Centenary Pool will be transformed to become our national aquatic centre, with more than 25,000 seats and multiple pools, ready to host international competitions and train the next generation of champions. New life will be breathed into the RNA Showgrounds, as well as housing the Brisbane Athlete Village. An upgraded 20,000-seat arena will host key events and give the Queensland Ekka an even brighter future. A major upgrade of the Queensland Tennis Centre will include a new 3,000-seat show court arena and 12 new match courts, which, in addition to Pat Rafter Arena, will bring even more tournaments to Brisbane. Across the city, existing venues will come alive. Plus, there'll be new and accessible indoor sports centres at Logan and Moreton Bay, and a new whitewater rafting centre in the Redlands. From Brisbane to the Gold Coast, faster rail with new stations will reduce commute times, while future upgrades to the Coomera Connector and M1 will connect growing cities. The Gold Coast will be home to an athlete village and host events at a new arena, an upgraded hockey centre and convention centre, while hosting the triathlon will showcase our golden beaches. In Toowoomba, the famous showgrounds will be transformed into an equestrian centre of excellence. To the Sunshine Coast, Queenslanders will ride the wave, a new direct rail line linking with a state-of-the-art metro hub that will connect to the Sunshine Coast Airport through Maroochydore. The CBD will be transformed with a new integrated athlete village, arena and cultural precinct. These Queensland Games will reach beyond Brisbane. delivering generational infrastructure for the whole state, including a better Bruce Highway connecting the regions and the rest of Queensland. This plan delivers legacy beyond the games with the largest investment in infrastructure in Queensland history. Athlete villages will become homes for thousands of Queenslanders. The private sector will be engaged to turn the Gabba into an entertainment precinct with new housing, giving Queenslanders even more ways to enjoy Brisbane and providing access to bigger and better sports and entertainment. A games we can all be proud of, and a legacy that will live on for generations of Queenslanders for decades to come.
Sounds like a plan to me. Let the games begin.
So from our viewpoint, I guess, and from a potential client's viewpoint, what's the value proposition? One of the most important things that I find where you can help people is to help them make common mistakes, because again, human nature being what it is, people tend to make similar mistakes over and over again. And as you can see there, I mean, there's no lack of information. I mean, there's lots of information available these days, but what do you do with it? How do you sort of then draw clear lines of decision making from all the information? And we often find, people say, I've been meaning to do this for years and I just want to do it now. And they go, look, just give me something. But any investment won't do. You can't ignore your point of difference. You should have unique attributes, and you should buy into a strong market of the future. So, if you're just buying something on price, and whether it's some, one or small 2-bedroom apartment somewhere where they've got a building that has hundreds of the same thing in the same building, that's not really going to generally give you a fantastic outcome, because you've got no unique attributes, there is no point of difference, and quite often you may be buying something because it's a lower price, but there's a reason the price is low. So, whether you're buying that in, say, in Melbourne, Docklands area, or Surfers Paradise, or a sort of single economy regional town like Port Hedland, all of those things, I think, come inherently with some great problems in terms of the underlying asset value, and will exhibit, generally speaking, a lot of volatility. So we tend to be far more conservative, for our clients. I mean, they're trying to build their wealth through property on a conservative, well-informed basis that enables them to utilise tax benefits efficiently and look at the underlying tailwinds rather than just the low price. So what do? We tie it all together. Like I said, you've got to have PIE, so population growth, infrastructure growth, employment growth, but you also have to maintain those unique attributes of your property. What's different about it, and what's the future sustainability of that? Because a lot of those tailwinds aren't just like, say, fly in, fly out in a mining town, because that may be over next year. So a lot of things to think about and consider. And if we look at, what are the opportunities, here's a sort of situation where I guess we look at what is appealing to most of our client base, people in general, what they're looking for. They're looking for high quality assets, quite often in lifestyle locations as well, because demographics are changing. So a lot of the baby boomers that bought their homes, as I said, 30, 40, 50 years ago, and they may have paid $30,000 for a house that they sell for $13 million now. It really changes the demographics. So these people are looking for high quality assets, looking for security, looking for a high level of amenity, close to particularly medical services, but certainly convenience of shopping, etc. And they have the money to be able to pay for these new dwellings. They're not going to be looking for a mortgage from the bank, so they don't really care what the interest rate is. And I think most people, especially younger investors, are not really recognising that, because they're thinking all the other investors are exactly the same as their cohort, where they're constantly battling to try and borrow enough money from the banks to buy what it is that they're looking for, and they're forgetting this massive marketplace of people who are looking to purchase something and have different capability. So important when you're looking at building your property portfolio. What we also tend to do is look at any potential investments both in a stage where before it's built, during it's built, after it's built, to give our client base the benefit of hands-on, if you like, quality control.
This is approximately 4 kilometres from the CBD, in close proximity to Royal Brisbane Hospital, and you have a lot of amenity around this area in terms of transport, in terms of restaurants, bars, places you can go to, Fortitude Valley, which is clearly not far removed. And it's interesting to note that the skyline here reflects some of the urban development that's happening in the sort of inner middle ring of the Brisbane region. We always like to have a look at construction before and during and after when sites are getting built to give us a far better understanding of what our clients are going to see when they receive their finished product.
And I think here it's important to note that we like to work with builders where the initial renders for a new project are actually what's delivered, and that's not so common. So that the end product looks the same as what you see in a render at the beginning. The other very important thing is, of course, the financial side of things. Who pays for these assets? And that depends to a large extent on the type of asset that it is. Also, if you're an Australian domestic tax resident, or if you're a non-resident, an Aussie expat working and living in another country. So typically here through cycles, this is what it looks like if you're an Aussie tax resident. You end up paying a very small amount of the pie personally, because the way things are structured, if you're buying a new property, the tenant and the ATO will fund most of that for you. We generally go through and have a look at a property investment analysis where we look at the costs involved in acquisition and the ongoing costs of ownership that asset's going to create. So if you're an Australian expat, non-resident, you can't use those tax benefits on an ongoing monthly basis. You have to save your tax credits till either you sell that property or you return to Australia and offset it against your personal exertion or capital gains tax income. So it's different if you're an Australian tax resident, because as you can see here, in a lot of instances you can actually acquire a good high quality asset that's new, where it doesn't cost you any cash flow on an after-tax basis. So you've got to go through obviously a lot of different things, and we look at that for people and then see what's relevant to them, because a lot of it depends on other financial commitments you may have. What's of greatest importance? Is it the level of capital growth? Is it the level of income? Or on a more balanced basis, and I think that's the best way to go, is it a combination of capital growth and income to enable you to perhaps build your portfolio more efficiently and more quickly. So if you have a look at this situation here on a graphical basis, who pays for what, you can see that over a period of time, that can generally take you right out of the equation, where not only is a tenant and the tax office paying for that asset, but you get to a situation where it's throwing off free cash flow, and obviously at the end of the day, that's really important, because later on you may be looking for those assets to actually give you an income, whereas in the early part of that cycle, you're not concerned about them giving you an after-tax income. You're really worried more about trying to extend the capital value of your asset portfolio. And Aussie expats without sufficient Australian taxable income, so they may not have 5 or 6 other properties that create that other income, taxable income in Australia. They can use those tax credits, as I say, when they repatriate. So this is a situation that has existed for a long time, continues to exist, where, generally speaking, I've seen so many people over the years and decades in the marketplace where if they buy a good quality asset, they don't actually have to do a great deal more except keep it. So the longer you keep it, you tend to find that level of capital appreciation continues to increase. But again, human nature being what it is, you'll see people generally sort of between 4 and 8 years, especially if they've done really well with something, and I say, oh my God, you know, I've received an offer I can't refuse, and I'm going to sell that. That may not be the best thing, because in a lot of instances, and I ask them the question, say, well, what are you going to do with the money? So if you're simply going to reinvest it, generally speaking, into a similar asset class, you know, why are you incurring both the sales and then acquisition costs, and most importantly, potential capital gains tax, when you don't actually need to sell that item? It's just it's an emotional decision you're making. And that's what I'm saying. Most people make ill-informed decisions and then have to pay the price. So really important. Property investment is a long-term process, as investment should be. You know, in current situations, I think a lot of what's deemed to be an investment, certainly in other asset classes or other things, really is just speculation or gambling. So you've got to be careful to segregate those and make sure that you're really keeping your investment portfolio separate to what you might be utilising for, say, speculation. So, you know, what's a solution we may provide people? Well, over 3 decades of experience. As I said, our lending business, Aussie Loan Guru, gives our clients the ability to get 85% loans without paying lender's mortgage insurance, or LMI, and that includes our non-resident Australian Aussie expat clients. Certainly if you're a medico, you know, Australian resident medico, lawyer, etc., other professions, you know, we're looking up to 95% loans. So it's really important, from not just being able to provide access to exclusive properties and deal with builders of the highest calibre, but a lot of the finance and financing adjuncts that we can provide to help people with that process. They can avail themselves of our concierge service, and that helps the whole light touch equation, I suppose. So, you know, if we'd have to look at things, obviously need to get some background information from people so we can actually assist them with their own situation. We do all that in terms of saying, well, look, you know, what are you looking for? What would you like us to help you with? And let's see if we can actually provide that and help you. And then you can make a decision and say, yes, that sounds good for me. I mean, I know what it's like, even if people who are living in Australia are buying something in the same state or in another state, you know, it's an anxiety producing process, and you do need, you know, other services that are potentially state specific, so legal practitioners being one of them, but ongoing support's really important, I find, for most of our client base. So if this has been of interest, then please contact us, you know, reach out, email us, call us, send us a WhatsApp, and we'll arrange, generally speaking, a Zoom meeting where we can get some more background information on what it is that you're trying to achieve and your particular goals. And you'll be sent a questionnaire after the quarterly review. So please let us know if there are any specific questions that you have. Be happy to answer those, and we can do that via email, phone call, or Zoom. I hope everything goes well for everybody during the course of 2026. And I'm just going to check, because I think that the latest quarterly CPI figures may have come out. We'll just see what they might have told us. Right, so that came out 11:30, so that's why I'm looking at it. And CPI rose by 3.8% to October, which is again on the high side. So we'll come through, we'll have a look at that, and we'll post something on LinkedIn to let all of our network know what's happening in the most time efficient manner. All the very best for the remainder of 2025. I hope all of our clients in Australia and around the world have an awesome Christmas and a fabulous New Year. I look forward to seeing you in 2026.